Hello friends, welcome to my channel and thanks for watching this video. On my video of do's and don'ts on stock market investment, I got some feedback from my friends and well-wishers that I should explain the concept with some practical examples. So in this video, I have taken one example of Reliance Industries Limited, and in another video, I will explain for Tata Steel. So Reliance Industries Limited, as you know, is the largest market cap company in India. So what I have done, I have plotted last 14 years key financial numbers of Reliance Industries, consolidated and standalone figures here in this Excel file. So here these are all P&L items like sales, EBITDA, EBIT before exceptional items, earning before tax, net profit, and these are all balance sheet items, cash, debtors, inventories, total net fixed assets, non-current investments, total assets, and these below this is the balance sheet related items on liability side, shareholders equity, non-current liabilities, long-term borrowing, short-term borrowings, all this thing. And then these are the cash flow items like net operating cash flow, net investing cash flow, and financing cash flow, how it has been performing. So if you look at this 14 years data, and then we have taken the cumulative figures of each data in column Q, and then column RST shows the last 14 years what has been the average sales revenue, last 5 years what has been the average sales revenue, and last 3 years what has been the average sales revenue. And for example, for each of the numbers, taken the average, simple average, and then I just calculated the CAGR, compounding annual growth rate. How to calculate the compounding annual growth rate? You can refer to my separate video. I have explained in a simple terms. So if you look at here, the total sales last 14 years has grown up by 16.4%. Last 5 years it has gone up by 9.7%, and last 3 years it has grown very sharply at 25% on CAGR basis. Similarly, all other ratios, if you look, all are in green zone because the growth has been tremendous. And if you look at the latest period, the shorter term time horizon, the growth has been significantly good. For example, EBIT, which is very important from looking the ROCE perspective, last 14 years average growth has been 13%. As we go closer to the time horizon, 18% in 5 years, and as we go more closer to 3 years, it is increasing by 22%. So very clearly the company has been growing very fast pace in the near term time horizon. Then net profit also, if you look at, it has gone up 10%, 11%, and 9.9%, which is good growth. So all ratios on the income sides or P&L sides is on a positive growth trend, showing in green zone. Now on the liability sides, if you look at, shareholders equity has grown up significantly, 15.7% in 14 years average, and 19.8% on 3 years average basis. On the contrary, if you look at the long-term liabilities, it has grown up from 18% in last 14 years and 11.5%. So they have grown at a lower rate CAGR compared to the net worth. If you look at all other ratios like cash flow, let's see cash flow how it has performed. So company has invested almost 646,000 crores in last 14 years, and the major increase has been coming since 2014. If you look at here, 73,000 crores, 65,000 crores, 66,000 crores, 68,000 crores, 95,000 crores, 75,000 crores. So last 5-6 years the capex growth has been phenomenal. So cumulatively the company has invested almost 650,000 crores in last 14 years. However, if I looked at from a different angle, that how much incremental return company has earned on this investment. So that is not so great because the last 20 FY20 profit was 39,773 crores, and 7 FY7 profit was 11,500 crores. So incremental profit, if you look at, company has got 28,000 crores by an investment of 646,000 crores. So that is 4.4% incremental return on the capital invested in last 14 years, which is not so great. However, what's so great is that all these mega investments company has made in last 6-7 years is likely to result in future profitability of the company at a very fast growth rate. So that's why investors today are valuing this company at a based on the future forward earnings projections of the company, because all these investments will yield great profits in future. If you look at few other ratios, the EPS trend has been increasing, and but on per share basis considering the growth in number of shares, it has increased in fact. So similarly, book value of this per share is showing negative trend in last 3 years, and it's only marginal growth in last 14 years. And this is another important ratio, book value of tangible assets, by excluding the impact of goodwill or other intangible assets, how the book value has been behaving. So that is also not growing last 14 years at all, very flattish 0.2% CAGR. And if you look at other margins ratio, they are all in red zone. 13% EBITDA margin is not so great. 13 to 15% it has remained. Net profit margin is so like 10%, 11%, 11%. It's neither so great nor so bad. Similarly, return on equity, if you look at, it has averaged between 8% range, 8% to 8.3%. So not so great, and but not so bad also, considering the size of the company. And return on capital employed, as you see, it has increased. It has remained in the range of 10.2 to 10.5%. However, the incremental return, as I said, it is only 4.5%. But we have to look at from the future perspective. These investments which the company has made, and now they have divested use shareholding in telecom and retail business, so that is likely to reduce the profit. So investors today are foreseeing the future financial projections of the company, that the net profit or EPS will go very high because of the interest savings, and company has turned from used debt position to a surplus cash position. So these ratios are very important. Now, if you look at the turnover ratios, it's in the amber color, not so great. The liquidity ratios, current ratios, and quick ratios are in the red color because they are far less compared to one. Long-term debt equity ratio, historically it has been in amber color, zero point 0.7, 0.73, 0.75. But as I said, because of the future projections, this will turn into positive, actually zero debt company. And we have to look at, so these are the ratios which we have to look at the from the future perspective. Similarly, price to book value ratio 1.46, it is not so great. Like, the company's share price has been in the range of 1.3 times, 1.4 times in the past 14 years, whereas at today's price it is already increased to 3 times compared to the latest available book value per share, and 4.47 times compared to the book value of tangible assets. So, and average PE of the company in last 14 years has been 11, last 5 years has been 12, and last 3 years has been 11.68. But look at this at today's market price, based on the latest available EPS number, it's coming 35.6. So theoretically it comes into red, but we have to look it from the prospective angle, that what is likely to be the future forward earnings of the company. And then if we compare this PE ratio, it's not that bad, like it's still has great potential to go up. Dividend yield, as I said, it has not been so great because the company has been focusing more on retained earnings and less on dividend distribution historically. Now let's see from another angle here. So if I look at the company's financials numbers here, let's say we put the same financial numbers here, profit for last 14 years, and the EPS here, what I have done, I have calculated based on the today's number of shares, because you can't compare the historical EPS when the number of shares were very low. When the company issues a bonus shares, number of shares goes up. So you have to convert the past EPS based on today's number of shares, so that you can make an apple to apple comparison based on today's number of shares basis. So if you look at the company's EPS, which was 29.49, based on today's number of shares, has gone up to 59. So almost 2 times increase in last 14 years. Similarly, the book value per share was 123 based on today's number of shares, and that time's shareholders equity has gone up to 644. So almost increased by 5 times in 14 years. And price to book value ratio, the average was 4.45 in FY8, and it has remained in 2.46, 2.23 range, and the average of last 14 years is 2 times. Whereas at today's market price of, let's say, 2234, which is the 9th October price I have taken. So if you look at the ratios, the PE ratio is coming 60 based on the 14 years EPS average, adjusted EPS average. So this comes to 60.72. And if we take the latest number of 59 EPS, then it was coming around 35 as we saw in the Excel file. So it looks very high theoretically, but it is not that high if you look at the forward projections of the company. So this is how the fundamental analysis we should do before starting any investment in the company. This will give us an idea, are we investing at right time, is the company's share price is overpriced or underpriced or at intrinsic value. Now let's look at the technical analysis. How do we do that? So yesterday I explained in my video on do's and don'ts that we have to plot the last 13-14 years price and put it into a high, low and average. So here I have put the high, low and average of last 14 years price, and this is the average high of last 14 years. This is the average low of past 14 years, and this is the average of past 14 years. And here I would like to say again, these high, low and average price I have adjusted with the bonus issue, because if the 2008, let's say, price was 1626, but company has issued bonus, given bonus issue of 1:1, so all the past years share price I have adjusted with the bonus issue by reducing it to half. Similarly, all these share price have been adjusted like that, so that it becomes apple to apple comparison when we compare how much 2234 is vis-a-vis these numbers, to look at the ratios. And this is the plot I have done, all these high, low and average numbers, put it here. So if you look at this chart, the company share price has been almost flat for 5 years, no real growth, they have been flattish. And suddenly from 2016 onwards, the prices have started increasing, because here the investors felt that whatever company is investing use capex in these years will grow the future profitability of the company. That's why they valued the company and share prices started increasing. And today if you see here, this is the purple line is the current market price of the share, 2234, which is very close to the peak level achieved recently. And this is the average of the high, the blue line. The green line is the average of the average, and the red line is the average of the bottom price achieved in the last 14 years. Now if we plot this and compare the ratios, what is the current market price vis-a-vis 2008 low, high? It's showing 275% versus 2009 highest is 330%, 359%. So all the ratios look very high. Company's price is already overpriced, looks like, from this chart. So it is coming into the red zone. Similarly, if we compare with the CMP versus lowest price of earlier years, it has increased by 685%, 961%. So like that, if you look at, except for one green, all are in the red zone based on my that day's video. If you look at do's and don'ts, where I've given the color codification for the technical factors, so you think it is all in red zone except one. Then CMP versus the average price of last 14 years, all are in the red zone. So it looks like the company price has already increased so much. But as I explained in that video, that these are the historical perspective. You have to look at the future perspective while calculating. That will give you real value of the company, what is likely to be, which ratios, how many ratios are in the red zone, how many are in the yellow zone, how many are in the green zone. Then only you can make a real judgment of the company, whether company's current share price is at its intrinsic value, or it is overpriced or underpriced. Should I wait or should I not wait? If it has already increased so much, whereas the fundamental factors have not grown so much, then you can still wait, because there will be some corrections. You will grab that opportunity that time, not now. But if you think that company's future projections are likely to be further improving, then the current price of 2234 may not be fully reflecting the intrinsic value of the company, because in that case all these EPS trend, price earning multiple trend, the dividend yield, the book value per share, what you feel today is very adverse, it may be looking very good when you compare with the future price scenario of the company's shares. So this is how this fundamental and technical analysis is done. And in next video, I will explain with another example of Tata Steel. Thank you very much. Bye for now. If you like this video, you can share with your friends. And I have put it on my video channel some other financial management and statistical related concepts on my video channel. If you like, you can go through that. Thank you very much for watching. Bye.